Value investing is one of the most misunderstood concepts out there. Everybody hears value investing and thinks about some miser sitting there saying, how cheap can I buy this? That's not always the case. I'm active on Twitter. When I'm on Twitter, I'll always hear people saying, I think the stock is undervalued, but probably doesn't because it's not selling for 12 times earnings. That's not what value investing is. So in this video, I'm going to go over some value investing basic concepts so you can understand it better. And I will tell you, I believe Warren Buffett when he says that value investing as a term is redundant, because true investing is about buying $1 for less than $1. Now, the question is, how do you calculate that dollar? And that's what we're going to get into in this video about how value investing, the basics of value investing. So first off, there are different forms of value investing. Ben Graham, known as the godfather of value investing, the original guy, he wrote Security Analysis, he wrote The Intelligent Investor, he was Warren Buffett's mentor. Ben Graham liked the idea of focusing on the assets and liabilities of the company. He didn't care about the business itself and how it was growing or dying or whatever. What he cared about was, can I buy a company that has enough assets minus liabilities on the books, the stuff they own, cash, buildings, etc., pay off all their debts, and still get a good return on that money? Back in the 1920s and 30s, that was possible because there was a lot of lack of information in the markets out there. It's not like today when you can literally go on the internet and find all the information on a company very quickly. So there was a lot of mispricings. Even Warren Buffett and Charlie Munger today say, based on the amount of information out there, value investors should expect less returns than they got in the past, which I agree with. It makes sense. Now, with that said, the idea of buying a company with enough cash on hand, during the Great Depression, there were a lot of companies where you could literally have bought the company, taken the cash, paid off all the debts of the company, shut the company down, and still made money. Think about that. You buy a company for $1 million, has $5 million in cash, has $2 million in liabilities. So you take the $5 million, pay off the $2 million, left with $3 million. You paid $1 million to get $3 million. You could have literally shut down the company and still cash $2 million in your pocket. That existed back then. That's very, very difficult to find today. Those are called the net nets. That was the original form of value investing. Focus on the assets and the liabilities. Focus on the balance sheet of the business. Then, fast forward, a guy by the name of Philip Fisher came out, and he wrote a great book called Common Stocks and Uncommon Profits. And what he was doing there was saying, listen, don't just focus on the balance sheet. Your job should be to find high quality companies that are growing and growing and growing, and that you can pay a reasonable price, but they're going to grow so much that it's going to justify their price today. And then based on different multiples, price to earnings, price to free cash flow, they might feel expensive today. But if you buy the right company, then it'll work out. So let me give you an example. Let's say there's two companies, company A, company B, exact same companies. Both of them bring in $10 million in revenue and both have $2 million in profit, exact same. Company A can grow their profit by 5% a year. Company B can grow their profit by 15% a year. Which one will you pay more money for? Obviously, company B. Obviously. Why? Because they're going to grow their profit at a much faster rate than company A. They're going to grow their profit at 15% a year. Company A is growing at 5% a year. That is the new world of value investing. It's about buying a company that is able to grow their profit at a higher return, higher growth rate than other companies, and you should pay a premium for that. Those tend to be companies with what's called a high return on invested capital, as well as a moat. And those kind of work together. What's a moat? Well, if you know a castle is surrounded by a moat, and that's what protects the castle. The bigger the moat, the more protection the castle gets. That's what's become a very, very popular conversation with value investors. How big is their moat? Moats can come in different ways, shapes, and forms. It's pricing, patents, quality of the product, service, etc. But the bigger the moat, the more likely their profits are to stay the same, stay sustaining, and growing at a higher rate. That is what's key for the moat. And that's what Philip Fisher started to create. That's what Charlie Munger bought into very early. And that's what Warren Buffett changed into when he met Charlie Munger. Charlie Munger was the first one to say to him, stop trying to buy these companies with hidden assets. If you go read Warren Buffett's first 15 or 20 years of his annual reports and his letters, he talks about finding companies with mispricings of assets and liabilities. Oh, I found this company with an $8 million stock portfolio, but the company is selling for $4 million. There's hidden value there. He did a great job with that. In the first 12 or 13 years, I think he averaged like 50% a year or something crazy like that. That's incredible. But now it's hard with so much money to invest in those small situations. With a lot of money, the hundreds of billions of dollars that Berkshire has, he is now focused on buying companies that have sustaining power for their business and can grow their profit at higher rates of return. One of the core concepts of this is understanding what the intrinsic value of the business is. And this is a very common phrase that is given in value investing world. I'm going to write it right here. Intrinsic value. What is intrinsic value? Well, in its essence, guys, and to keep it very basic, what's the value of the business? What would it go for on the market? Okay, so the issue is intrinsic value is a subjective matter. This is what makes investing an art. Warren Buffett and Charlie Munger always say, if you ask each of us what the intrinsic value of Berkshire Hathaway is, we're going to come up with different numbers at different times. It's going to move. How much is it going to move? Probably not by 30 or 40% each time you do it, but as your assumptions change, as your information change, this is intrinsic value. Now, once you determine the price of the business, the major concept of value investing is this, and this is what's most important: margin of safety. The analogy Warren Buffett always gives is, hey, if you're going to build a bridge and you're going to have 10,000 pound trucks going across it, you don't build that bridge to carry 10,000 pounds. You build that bridge to be able to carry 20,000 pound trucks because you need that margin of safety. The same thing applies in investing. What's your margin of safety? Well, it's the difference between intrinsic value, IV, versus price. Now, again, if you watch our videos and you watch the bigger companies we do, my PEs are not 8, 9, 10. I'm not trying to buy companies at 9 or 10 times earnings. I will routinely put 15 and over PE and price to free cash flow in our assumptions. Why? Because I'm buying big, stable companies. But when I do my desired return, that's where I put my margin of safety in there. Margin of safety is in my desired return. If the market's going to get 9 or 10% return, that essentially is what I calculate as my intrinsic value. Okay, if I buy this company and I make 9 or 10% return, that's basically what the company is worth to me. The higher my return, the more my margin of safety, because the higher return, the lower the price. If I think something's worth $100 and I want to make a 10% return, I got to pay essentially $90.91 for it. If I want a 100% return, I got to pay 50 cents for it. The higher my return, the lower the price. And that's where I drive my intrinsic value versus price, that margin of safety. The larger your margin of safety, the idea in value investing is the more you have here, even if you're wrong, you might not lose a lot of money, if anything at all. You might just make less money. That's the idea here. But the hard part about investing is that the larger the company is, the harder it is to find mispricings. In fact, to find mispricings on major companies, it takes a really deep bear market where the entire market is down. It's not going to happen very often. We saw Facebook last year selling at $88 a share back in November 4th, and now it's at $300 or $270 or whatever it is, and it was selling for $300 before then. Those are not very common. And if you have the guts to be able to back the truck up and buy Facebook when it's sub 100, more power to you. And there are people in our community who did do that. I got very lucky and happened to buy shares literally on its lowest day. But guess what? I also started buying shares of Facebook at a much higher price. And as the price went lower and lower, I thought to myself, this is just a mispricing of the market. I want to own this company. And I bought some more. But that's the hard part about value investing. It's Mr. Market, this entity telling you this is the price today. But you've got to be able to sit there and say that's not really the price, the value of the company. That's the hard part about value investing. Investing in general is all about emotion. It's all about discipline because news follows the price, not the other way around. When the price is down, the news is going to sit there and say, okay, what news justifies that? When the price is up, what news justifies that? It's not the other way around. So you've got to be disciplined. And I learned this only recently where I sat there and said, wait a second, successful investing isn't about understanding the numbers. It's about being disciplined and rational. Here's my rationality on value investing. If I can find a company that I can buy with a projected return of 13% a year, which is above the market of 9 or 10%, and I sit there and say, wait a second, do I think this business is going to be bigger 10 years from now than today? If the answer is yes, and I can pay a reasonable price for it that gives me an adequate return, that's what it takes. The hard part is when stocks are falling and everybody's scared, all the news is going to be out there saying how terrible the company is, how bad it is. Look at Zuckerberg. People were criticizing Zuckerberg when the stock was sub 100. He's a terrible CEO. He's awful. Needs to be fired. Now he's a god again. How is that possible? How is that reasonably possible? It's not rational, but it's hard to be in the emotion of it and say, yep, this is wrong. Because Mr. Market every day is telling you, here's the price. Are you a buyer, seller, or are you going to hold? It's your decision what you're going to do on that one. Think about your home. The reason you do so well in your home is you don't check it every day on its value. There's no billboard on top of your home telling you the value every single day. Because I bet if it did, and you saw that price falling every single day during a bad time, you'd be like, oh boy, I got to sell my house. But it's not the case. That doesn't happen. So it's much easier. And you also have utility in your home. You're living there. You're spending time there with your family. That's why it's easier to do that. There's a tin can theory in investing where people who just bought the 30 Dow companies and just put them in a tin can and never thought about them ever again tend to do better than the market, or tend to match the market at least. Why? Because they're not thinking about it. They're not jumping in and out of investments. That's the key to value investing. Margin of safety is where you're going to get your buffer. And it takes discipline because you have to be inactive. You got to be patient, waiting for that margin of safety. And when the stock does fall, guess what's going to happen? It's going to fall further. And the key for you is that when it falls further, to be rational enough to say, is it really something fundamentally in the business that's changed, or is it the perception? That's the hard part about investing. That's the key part. If you can keep discipline and understand that it's probably just the market sentiment, you'll do very well. Now, it could very well be the business has absolutely changed. Look at BlackBerry. BlackBerry in 2007, 8, 9. It was the number one phone, right? Or something like that. And then all of a sudden Apple came out and they started to do well, but who would have thought Apple would be this big piece of the market and BlackBerry to fall in that much? There was a fundamental shift in BlackBerry in that market. That's hard sometimes. And that's going to happen here or there, but that's why I believe in having multiple companies. I personally believe in having 20 or 30 companies because it's not likely that the majority of them will have some cosmic shift like BlackBerry had. Now, before I get into explaining to you the numbers of investing, I wanted to do one favor. If you'd like this video so far, subscribe to the channel. That's all I'm asking you to do. Subscribe to this channel. We have a lot of great info. Make sure you allow for notifications so you get notifications when we set on a new video. We do 2 videos per day. We're very active here. So let's go over some fundamentals of the business. All right, so I'm going to pull up our community software. Let's pull up a company like Microsoft. So when it comes to fundamental analysis, it's about understanding what the business is like. What does the income statement look like? What's the cash flow statement look like? What does the balance sheet look like? Now, if you're like me from years ago, I didn't understand any of these things. But once I understood them, it opened the world to me of saying I can be more patient. When you understand something, the more you learn, the less you fear. The more you understand, the less you will fear. This is true of everything. If you're not a surgeon out there and I told you perform open heart surgery, you would be scared shitless. But if you're an open heart surgeon, you're going to go, okay, let's go do this, right? If you're Bryce Harper getting up to the plate to bat, you're going to be like, okay, I'm ready to go. If you're me going to the plate against major league pitchers, I'm scared shitless. The more I understand, the less I'll fear. Same thing here. So you pull up a company like Microsoft, and on our main page, we talk about high-level things like the market cap, the net income, the 5-year average net income, PE, things you've heard before, profit margin. It's all about getting an understanding overall of the company. How's their health? And one of the best places to look at health is balance sheet. The balance sheet is where you can look at and say, how much cash and stuff do they have? How much do they owe people? That's important. Just like I always tell people, your life is basically a corporation. You bring money in, you have assets, you have bank accounts, you have liabilities. Liabilities could be student loans, car loans, credit cards, home loans, etc. Your assets are your brokerage account, your bank statements, etc. No different. And your income statement here is the money you bring in, and then all the expenses you have, and the net income is what are you left with at the end of the year. Those are really important. And if you think about a company the way you think about your personal life, you're going to do very well understanding that. It's no different. Yes, there are accounting rules and things like that, but if I told you right now that you owed $10 million and your income was $200,000 a year, hey, newsflash, you're going to have problems. No different with a company. If a company makes a lot of money, but they have 30 times more in debt than that money is, they're probably gonna have problems at some point. And that's why we sit here, and if we go to our 8 pillars, I love our 8 pillars because it sits there and explains from a high level view, kind of a story. So I look at Microsoft here. First one is 5-year PE. Okay, it's an X, because it's pretty high, 40. Could it be high? Well, like I said before, if I knew Microsoft was gonna double their income every year for the next 10, this is a very easy price to pay. And I'll get into that shortly with our stock analyzer tool. Our other X is price to free cash flow. So you might be wondering, well, Paul, what's the difference between net income and free cash flow? Well, over long periods of time, they should be the same. But when it comes to net income, which is the earnings number, there's a lot of SEC rules, accounting rules that can modify things. Free cash flow is cash from operations less your capital expenditures. It's harder to manipulate. So when I see differences here, it's always a red flag for me if net income is higher than free cash flow. So in this situation, if net income is higher than free cash flow, the ratio will be lower. And it's a little bit lower, but it's not that much lower. It's 40 versus 44. It's not a big deal. If it's within 10%, no big deal, okay? Next thing, return on invested capital. Value investors love return on invested capital because it says, here's how much money we make on the money invested in our business. There are 2 ways to invest money in a business, debt and equity. The return you're getting on that money invested in the business, and I've said this in 1,000 videos, debt and equity is the 2 ways you fund a business. This is the return they get on there. So this means theoretically that if they invest more money in the business, they should continue to be able to grow their profit by this % on that money they put in the business. Now, the key is, the hard part is, how does a company like Microsoft invest $100 billion into the business? It's hard. They're already really big. All right. Next one, shares outstanding. Guys, are they increasing the number of shares or decreasing? Are they diluting you by bringing on more partners? Because when they increase the shares, they're bringing on more partners and giving you less and less of the business. It's the silent killer to investing. I like to see them buying back cheap shares. Cash flow growth in the last 5 years, what have they grown their cash flow by? Net income, what have they grown their net income by? Revenue growth, how much have they grown their revenue? And debt, long-term liabilities divided by 5-year free cash flow. So this tells me, hey, Microsoft's a pretty good company. We just have one problem, maybe pricing. That's it. So we have to be patient. Either the fundamentals need to get better, or the stock price needs to fall, or some combination of the two. But this is why I have Microsoft on my watch list at a certain price. That way I get notified when that happens, all right? Now, like I said to you before, when we look at the stock analyzer tool, this allows us to sit there and determine, let me pull up Microsoft here. The last time I did Microsoft was July 25th. I did this analysis, but look here at the bottom, my desired return. I did my 10% for my market average. I did 12% for a little bit higher assumptions and 14% for the highest assumptions. My goal here is to sit there and use the numbers of the future, what I determine, make my assumptions, what price should I pay for that company today? And this is my margin of safety. Anything over 9 or 10% essentially is your margin of safety. And 12% a year doesn't sound like a lot versus 10, but over a 10-year period, it's a big number. And we can do analysis up to 20 years. So guys, in conclusion on this one, value investing is a wonderful place to be. But if you chase hype, if you get scared very easily, just invest in long-term ETFs and match the market. And over time, like me, I used to be 100% ETFs. Then as time shifted and I started to become more of an investor in individual stocks, I shifted more money into stocks. Now I'm 100% of my money will be invested in stocks, no ETFs. But it takes a certain discipline. It takes that ability to say, I'm okay waiting. Because inactivity is the best thing for investing. Again, guys, thank you very much. And please subscribe to this channel if you found this video useful.